Good morning, dear students. I hope you are able to hear me. And thanks for joining in again. I know it's rainy at a lot of places, and you feel like, let's not attend, let's sleep for some more time. But still, you're turning up. That's a very, very good sign, and that also encourages me to come up and show up every day at 5:30. Right. Good morning once again, everyone. Any questions you have from yesterday's session or even 2 days prior to that? If you have any questions, you can feel free to ask. Otherwise, we'll continue and we'll try to cover major portion of leases today. And if something is left over, which I'm sure it will be because it's a very, very long standard, and something is left over, we'll complete tomorrow. Now, my suggestion to those of you, who have been attending for the last 2-3 days is go back and complete questions, go back and practice questions, because that is very, very important. Okay, even if you don't want to practice all the 50 questions, wherever workings are involved, wherever modifications related questions are there, please try to complete them on your own. And if you have any doubt, you can ask it on our app in the forum section. That should be perfectly fine. And then alongside, once we complete leases, whenever questions have been tested, the notes contain which year what question has been tested, so that also you can revise so that you get some amount of confidence before your examination. Okay, so just a second, it gets connected. Good morning, Shivaji, Murli. Good morning. Good morning, Rajita, Kalyan, and Krishnan. Good morning, Dagajit. Good morning, Ram. Okay, thanks a lot. Let's continue. I know a lot of you have been thinking of watching recorded version, but as I told yesterday, if you keep piling it up, it will not get completed, and that is why it is important to show up every day. That is when you will be able to complete. Okay, I know if a lot of you have late night workings or peak seasons, or July 31st filing time, all of that, I understand that part of it. But for others, to the extent possible, attend live so that we complete it simultaneously. The objective is to what? To complete the revision and get ready for the examination. Now there are some simpler topics. Modification was one big, very important topic, and for which I have given the entire detailed solution working as requested by some of the students. Now moving on, separating lease and non-lease components. Now what is this lease and non-lease components? Let's take a small example, and then we'll be able to follow up. Just give me a moment. So now when we say lease and non-lease, what do we mean by that? Think of a case where, let us say, you take a building on rent, or a lot of you would be staying in rented flats and all of that. What happens is the owner says you have to pay rent of 50,000 and maintenance of, let us say, 5,000. So what is this maintenance? Security, water, electricity, common area, and all of that put together, it is 5,000. Now rent gives me the right to use an asset, whereas maintenance does not give me any such right. Maintenance is more for the day-to-day convenience for which I am paying. Now if these are separately identified in the contract, how much should be the lease payment? If you can put the comment down, how much should be the lease payment? Lease payment should be 50,000 only, whereas this 5,000 is not a lease payment. But sometimes what happens is, the lessor, what he does is, he says combined 50,000 per month or per year, whatever the case may be, 50,000 per month or per year you have to pay, which includes rent component and maintenance component, both of them. Okay, now in that case, what the standard says is, if there is a lease component which gives us right to use an asset, and if there is a non-lease component which does not give us any right to use an asset, those two you have to separate and separately account for it. Meaning to say, this 50,000 I will separate. So how will we separate? You will go back and check what is the standalone prices. I'll just use the same terminology what we use in Ind AS 115. You'll go back and check what is the standalone or individual prices. Meaning to say, if I have to rent, how much do I need to pay? I need to pay 50,000. If I have to pay maintenance, I need to pay 5,000. That is standalone. Okay, but I have negotiated and brought it down to combined value of 50,000 per month. So now this 50,000 has to be split between right of use asset and another non-lease component. Why? Because based on the lease payment, I will create a ROU asset and this will be expensed periodically. Now for that what you need to do, if I had taken individually, I had to pay a total of 55,000. So total amount payable is 55,000. This you will understand more when we do Ind AS 115, that is after Ind AS 116, where we will be able to understand the allocation of transaction price to standalone prices. Okay, 50,000 is total. Out of this, 50,000 is for asset, and for maintenance it is 5,000 out of 55,000. But we are paying only 50,000, so we are allocating 50,000 out of here. Whatever number you get, this portion will be the lease payment and this portion will be your non-lease payment. Okay, a lot of time it happens, especially when you enter into, let us say rent of machinery or rent of car. They would say car plus maintenance. So when it is car plus maintenance, maintenance is separate and the car part separate. Okay, that is how we separate the lease and non-lease component. Now that is lease and non-lease component separation. So there are some cases where a contract may contain lease component, which is a right of use asset, and other related goods or services, which is non-lease component. For example, if it is a right to use property, it could be maintenance services, right to use coffee machine, supply of coffee beans, right to use a truck, supply of drivers or service of drivers. So non-lease component should be separated and accounted for separately. Now, apart from this, lease and non-lease component, sometimes what happens is you have multiple lease components. So for example, you enter into a contract to rent a truck and a car. Now, when I rent a truck and a car, this is a separate asset. This is a separate asset. Now tell me, do I need car to use the truck, or do I need the truck to use the car? Do I need a car to use the truck, or do I need the truck to use the car? Both of them are independent. I can use the truck independently, I can use the car independently. So what the standard says is, whenever there are more than one right of use asset which you can use independently, then this will be a separate right of use asset, this will be a separate right of use asset. Sir, how do we allocate the price? Let us say if you have combined price of 1 lakh per month, same logic. What is the standalone price? Let us say this is 80,000. What is the standalone price? Let us say this is 40,000. So this 1 lakh should be allocated in the ratio of 80 and 40, that is 8:4 or 4:2 or 2:1. So 66,667 and 33,333, and that way you will have two right of use asset account. So the summary is, if there are lease and non-lease, separate. If there are more than one lease, then also separate. How do we decide when do we separate the lease component? If the benefit from the asset either on its own, for example, I gave an example of car and truck, either on its own can be easily taken, means you can take the benefit directly, or with resources readily available, that asset plus another resource. Let us say I need a driver, So resource asset plus driver, because that is independent, separate. Okay, you can use the car separately, truck separately, and the asset is neither highly interdependent nor interrelated. Now, how can you relate a truck and a car? Okay, in that case, you will say that there is a separate lease component. Okay, sorry, if these conditions cannot be met, or if these conditions are not met, then you will say these are not separate lease component, but these are single lease component. So that is the criteria for segregating lease and related non-lease component. Sometimes what happens is, you take, let us say, an engine on lease, and then you take wagons where you carry goods. So you took a engine on lease and wagon on lease. Now, without this wagon, or without this engine actually, how will I use the wagon? I cannot use the wagon. So here they are interdependent and interrelated. So I will account for them as a single right of use contract. Okay. So that is what is the concept of separating lease and non-lease, and also separating separate lease components. Now, there is an optional exemption, which we also call as practical expedient. Now, whenever we hear this term practical expedient, it means that there is a lot of difficulty in calculating or accounting for this item. So what the standard setters do is they give you some kind of relaxation. Okay. Now this relaxation is available only to the lessee. Now what is the relaxation? The relaxation is that if there is a lease component and non-lease component, so lease and non-lease, they can account for it as a single contract. They can account it for as a single contract. That is one. Okay. And if there is more than one lease component, then you cannot account for it as a single contract. So what is the meaning of that? The meaning of this is, if I am a lessee, I have one right of use asset plus one non-lease component in a single contract. I can account for them as a single unit. If I have two right of use asset plus non-lease, this I cannot account, or I cannot get the exemption. So for example, if this is a car and if this is a driver, I can say, okay, both of them put together a single asset. But if this is a car and if this is a truck, then this exemption is not available. So that is one optional exemption available to lessee. Then there is another concept of contract combination. These are more theoretical in nature. Hardly we see these kind of questions being tested in the examination, but if at all a theory question comes, this becomes very, very important. Now, contract combination. Now, what is contract combination? If there is a contract, and there is one more contract. So basically you need two or more contracts which are entered into near about the same time with the same or related parties, then you have to combine them into a single contract provided some criteria is met. So here what we are saying is, let us say I entered into a contract for first floor of the building. This is contract number 1. This is with the father. Okay, this is with the father. First floor, I have entered into a contract with the father. The second one is with the daughter. For tax planning purposes, they transfer, or they make that the daughter purchases the property, and some kind of tax planning will happen. Sir, income will be clubbed. No, income may be clubbed, but income will not be clubbed, right? So for that they may have a tax planning requirement. So daughter has the second floor. So we enter into a contract for renting the property with the daughter. Okay, both of them are in the same building. So why did we enter into two contracts? Because one is with the father, one is with the daughter. Both of them are related parties. When did we enter? We enter into near about the same time. With whom? With same or related party. Assets are also similar. Now here, legally there are two contracts, but in substance they are like a single contract. So what the standard says is, you combine both of the contract and account for them as a single contract. Okay, that is what is the concept of contract combination. Okay, so if there are two or more contracts near about the same time with the same or related parties, you will combine them into a single contract. Now that single contract has certain criteria. What is the criteria? Simple. Negotiation was happening as a package with a single objective. So when we negotiated, we didn't negotiate with the father separately and daughter separately. We negotiated with both the parties as a single package. We talked to the father. Father says, yes, this property is with my daughter. Okay, property is with the daughter. But we'll negotiate with you only or with both of you together. Second, consideration paid in one contract is dependent on consideration paid on another contract. Meaning to say, because both the contracts were negotiated together, the amount that you're paying as rent is also dependent on one another. Then third, this right of use assets under different contract are single lease component. Single lease component means the criteria to have them as a single lease component, they are interdependent, they are interrelated. All of these are these conditions are met, and in that case we will account for them as a single contract. More important from theory perspective, if at all you get an examination question when you have to combine the contract. Now what is the implication of combining the contract? The implication of combining the contract is the rent that you pay here and the rent that you pay here, both of them will be put together and there will be a single right of use. Both of them will be put together and there will be a single right of use asset. I hope it is clear. If it is clear, you can just comment it as yes. I'll consider it as a signal to pass on. Move further. If you have any questions, you can feel free to ask. Then there are some presentation and disclosure requirements. These are more self-explanatory, but I'll just quickly run you through this. In the balance sheet, you will present the right of use asset and these liabilities separately from other assets and other liabilities. So generally, if you look at the annual report, you do look at refer at an annual report. There you will see that along with, let's say, property, plant and equipment, you'll have a separate criteria, classification or bifurcation which says these are ROU assets. Again, lease liabilities is separately presented. Okay, that is one. Then, if you are combining and presenting with other assets, you have to disclose which line items contain the right of use asset and liabilities. Generally, these type, it's very unlikely that you get a question based on this, but still. Then, you cannot net off asset and liability and present it as a net item. In the P&L, you will have interest you will have to disclose separately, and you will also have to disclose the depreciation part separately. And in the cash flow, repayment of lease liability and interest is financing activity. If there are short value payments, operating activity. Variable lease payment, operating activity. Then in disclosures, you can have a look at all of these disclosures. There is nothing much to be for me to explain it to you. Whatever we have calculated, all of that thing you have to disclose. Now comes the most interesting, and when we learned accounting standard 19, this was one of the most important thing. Learning this 5 terms, that is what we will be understanding. The classification between finance lease and operating lease in case of lessor. Okay. So when we talk about a lessor, we have to classify it as whether it's a finance lease and operating lease, and accordingly the accounting treatment would change. Okay. Now, again, I'll not go into too much of depth of calculation. Okay, we have already understood broad aspects of this concepts and requirement. If you have any questions after that, you can feel free to ask. But the logic of this, how to calculate and all of that, in detail, I'll not be explaining. Okay, so that is first thing I want to clarify. Right. Now, when we say finance lease, the underlying communication that we are making is that lessor is financing. Lessor is financing what? The asset purchase of lessee. Okay. Now, think of it. I keep on giving this scenario. Let us say I want to buy an aircraft. If I have to buy an aircraft, option number 1 is I go to a bank, I take a loan from the bank. Here is the lessor, here is me, lessee. Okay, lessor, lessee, and the bank. What do I do? I go to the bank. I say I need a loan. Why do you need a loan? I need a loan to buy an aircraft. Okay, you take a loan, and sorry, it's not lessor now. Lessor will come subsequently. Lessor, lessee, lessor, lessee. So let's go. I go to a bank and I say I need a loan for what? I need a loan to buy an aircraft from Airbus. I need a loan to buy an aircraft from Airbus. Now, if I need a loan, I'll apply for the loan. Bank will pay the money to Airbus. Airbus will send me the aircrafts. Airbus will send me the aircraft. Okay. Now, in this case, I have taken a loan from the bank. and the bank has paid the amount to Airbus, and Airbus has supplied me the aircraft. This is a normal transaction that can happen. But let us say bank refuses. Bank says, I don't want to give you loan. Bank says, I don't want to give you loan. You will default, you have a poor credit score, you are Vijay Mallya, I keep referring to in the class, brother of Vijay Mallya, Queenfisher Airline and all of that. So, I don't want to give you loan. Okay, you don't want to give me loan. Then what is the option? Now let us say this is me and this is Airbus. I'm not getting loan. So, I go to Airbus and say, see, I'm not getting loan from the bank for whatever reasons, but I need the aircraft. Airbus says, I cannot supply you aircraft for free, of course. And can you give it on credit? No, I cannot give you outrightly on credit. Okay. So what can you do? The Airbus says, okay, I will give the aircraft to you on lease. I'll give the aircraft to you on lease for 30-year period. And this 30 year is non-cancellable. So whenever we are saying lease term, the thing that should strike your mind is, sir, the lease term is non-cancellable. So this 30 year is the non-cancellable period, and 30 year is also the useful life, or maybe 32 years is the useful life. For the entire useful life, I have the asset which I will be using. And Airbus will be giving their flights to airplanes to me. What will I pay? I will pay monthly or periodic rental. I'll pay monthly or periodic rental. Now, why is Airbus doing all of this? See, first thing is Airbus wants to sell its aircraft. Now, will it give me the aircraft for 30 years at the cash price itself? So today, if the price is, let us say, 100 crores, will it say you divide 100 crores over 30-year period and each year pay me equal amount? He will not say that. He will say, you are paying me consideration over a period of time. On this 100 crores, I will also charge interest. So this monthly rental or annual rental is something like an EMI. Every year you have to pay to the Airbus company, or every month you have to pay to the Airbus company. Now, this scenario as compared to this scenario, if you see, here also I have taken loan from the bank. To the bank also I pay EMI, and Airbus has supplied the aircraft to me. Now here bank is not there. This Airbus itself is the seller, and Airbus is also acting as a lender because it gave me aircraft, and in return on the value of the aircraft it is charging me interest. Just that bank is out. Airbus itself is the bank, Airbus itself is the seller. So that is why we say it is a finance lease. Okay, it's itself a finance lease. Now, why it is important to understand that it is a finance lease? The reason is, if I am using the aircraft for 30 years period, I am getting all the benefits from that aircraft for 30 years period. Airbus is not getting any benefit. When Airbus says I have an asset, what is Airbus saying? I will get the benefit from the asset. Now, the airplane which is transferred from this airplane, Airbus is not getting any benefit. What it is getting is money or sale value plus interest. So this is where Airbus is financing the aircraft for me. Now what is in for me? See, if I purchase the aircraft also, I'll use for 30 years. If I've taken it on lease also, I'm using it for 30 years. For me also, it doesn't make a difference. For 30 years, it is non-cancelable lease, right? Now, in these kind of scenarios, when the substance of the transaction is that the lessor is financing the asset, in that case, we say these are finance leases and we have to account for them as finance leases, which is basically not a lease transaction, but like a outright sale transaction. Okay. Now, Some of you may have a question, especially when you are having the background of AS 19. Sir, why did we not do this classification in the books of lessee? In the books of lessee, why did we say that all the right of use asset and lease liability you have to account for? The reason is that earlier, when we had the previous standard AS 19 or the corresponding in AS 17, earlier what used to happen is operating lease for lessee, this was outside the balance sheet, or we call it off balance sheet item. It was not shown. Finance lease was on balance sheet. The moment finance lease is on balance sheet, what happened is you have to make more disclosures. You have to tell that I have taken it on lease, it's a long-term contract and all of that. So avoid this, what lessee started doing was finance lease also they started to show as if it is an operating lease. Finance lease also they started showing that it is an operating lease. So to avoid all of that, when the new standard was introduced, that is in AS 116, in that case, or the corresponding IFRS 16, okay, then in that case both operating as well as finance lease were to be shown on the balance sheet, right? Now that is about broadly why it was needed and what is finance and operating lease. Now coming to the specific discussion on the conditions to be satisfied. Okay, now please remember, when I say finance lease, the lessor is financing the purchase. Lessor is financing but legally there may not be purchase, but if you look at the substance of the transaction, it is as good as the lessee has purchased this asset. So what are the 5 conditions? If any of these 5 conditions are satisfied, then we say that the the lease is a finance lease. First one, there is an ownership transfer at the end of the lease term. So show it right. First one, there is ownership transfer. Now when I say there is an ownership transfer, let us say I am talking about a asset which has a 10-year useful life and 7-year is the lease term. 7-year is the lease term. After the 7th year, what happens is the asset automatically gets transferred to the lessee. The asset automatically gets transfers to the lessee, something like a hire purchase transaction. So the lessee will use for the 7 years and the lessee will also use this for 3 years and he will become owner after 7 years. So this is as good as a finance lease where the asset, the risk and rewards related to the asset is being transferred to the lessee. That's the first thing. Second one, there is an option to purchase which is likely to be exercised. What is the meaning of this? At the end of the 7 years, there is no transfer, but the lessee has an option to purchase the asset. Maybe market price at that point of time will be 1 lakh. The option price is 30,000. So if option price is 30,000 and if the lessee is likely to exercise this option, then in that case, what happens? After 7th year, the asset becomes that of the lessee. That is the second term. Then third is asset is, or the lease term, I think. Lease term of asset is substantially major part of life. Okay, substantial part of the life or major part of the life of the asset. Now what do I mean by that? The life of the asset is 10 years. It is under lease for 7 years. Now in this case, do we say it is major part of the economic life of asset or not? Okay, so normally we take a condition of 75% here, that if it is 75% or more, then it is a major part of the economic life of an asset. Okay, so in that case 7 years will not be a major part and hence you will not call it to be a finance lease. If it is for 8 years, then you will say it is a finance lease. Then Fourth one, very important one, present value of lease payment. Present value of lease payment is, I am directly saying, giving the number 90% of fair value. The language used in the standard is substantially all of the fair value of the asset. So whatever is the fair value, substantially all of the fair value. So maybe almost entire fair value of the asset, that is the present value of lease payment. So if say for example fair value of asset is 1 lakh, present value of lease payment is 95,000. Now tell me, why will someone pay 95,000 to for a lease, which when I think present value lease payment, discounted present value, why will I pay 95,000 towards a lease contract? Why, where by paying an additional 5,000 I can take it or I can purchase it itself. So my idea of paying 95,000 is to get 95% of the benefits from the asset. We can think it that way. So here, if the present value of lease payment is greater than or equal to 90% of the fair value, then in that case also it is considered to be a finance lease. Okay. And lastly, if it is a specialized asset which does not have any use to lessor. So something like, let us say I have installed a centralized air conditioning in my office, which I have taken on lease. Now that centralized air conditioning system will not be of use to the lessor after the contract gets over. Or I have taken some asset which can be used only by me. I have given a customized order. I'll take that on lease, but that asset can be used only by me, not by the lessor or any other third party. So in that case, if there is no use to the lessor, then we say, or lessor or any other third party, then we say this is a finance lease because the asset has been made for the lessee. So to quickly revise the 5 condition, first, if there is an ownership transfer, then the lease is a finance lease. If there is an option to purchase and the lessee will exercise, then also it's a finance lease. If the lease term is for major part of the economic life, finance lease. So most important, where you need calculation, is present value of lease payments is substantially all of the fair value of the asset. Now here, present value of lease payment, at which discount rate will you discount? What is the discount rate you will use to discount this present value of lease payment? Can you just put it out as a comment? What is the rate that you will use? Do we have any practical question? So combined contract is basically, you will, if at all the question comes, you have 2 numbers or 2 contracts, you combine them and account for them as a single lease payment and right of use asset. The working doesn't change. IRR. Okay. Now here, please don't say, sir, if you don't know IRR, we will use incremental borrowing rate, because lessor is doing the calculation. Lessor will know what is the implicit rate in the lease. The lessor will know what is the implicit rate in the lease, and hence it will be done at IRR only. Don't say incremental borrowing rate. It is for lessee. Sir, why lessee? Because lessee may not know what is the implicit rate of return. Lessor can't say I don't know the implicit rate of return. Okay. So if these conditions are satisfied, we say that it is a finance lease. If none of the conditions are satisfied, we say it is an operating lease. Then there are some additional conditions which say that, okay, the transaction could be a finance lease. First one, so these are additional conditions, meaning to say the 5 conditions are not satisfied, but one of these conditions are satisfied, which means though these first 5 main conditions are not satisfied, these additional 3 conditions are satisfied, one of these 3, which can lead to a conclusion that yes, it is a finance lease. First one, if the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee. What is the meaning of that? If lessee cancels the lease, If the lessee cancels the lease, whatever loss the lessor incurs, will be borne by the lessee. In other words, the lessor is transferring the risk or the losses to the lessee. So if these kind of arrangement are there, if the lessor would incur a loss, for example, I have taken something on lease, I cancel the lease. Because of my cancellation, the lessor is not able to find another lessee. Okay. Now, when the lessor is not able to find another lessee, whatever is the loss, the lessee will bear. So, when the losses are being transferred, we can say the risk and rewards are being transferred, and hence the lease may indicate that it is a finance lease. Then, gain or losses from the fluctuation in the fair value of the residual accrue to the lessee. Now, what is the meaning of this? If there are any, whatever is the residual value, the gain, if there is a gain because of price fluctuation, or if there is a loss because of price fluctuation, that is given to the lessee. Now, generally, residual value should be enjoyed by the lessor, but here we are saying it will be enjoyed by the lessee. So, in that case also it could be a finance lease. And lastly, the lessee has the ability to continue the lease for a secondary period at the rent that is substantially lower than the market rent. So, here also lessor is not getting the benefit of the asset because secondary period means after the lease term, the lessee can again continue the lease at a lower than market rate. And if that is the case, the lessor doesn't enjoy that benefit. And in substance, what we can say is the asset has been transferred to the lessee. Not very important for you to remember these more over and over again, but from a practical standpoint of view, these are additional criteria which can be looked into when we say the lease is a finance lease. Now, one thing you have to understand is underlying principle or underlying theme is if the risk and rewards incidental to ownership are transferred, then the lease is called a finance lease. Then, if there is a land and building, you will do separately land and separately building if the the leases are of land and building because their life are different. Okay. Now, when we come to lessor accounting, especially for the finance lease, then we need to understand what is the gross investment in lease and what is the net investment in lease. Now, what is the gross investment in lease? Gross investment in lease is, please remember this term, a lot of students get confused, sir, what to include, what not to include. Gross investment in lease is lease payments. Now, one side we have lease payments. So, who makes these lease payments? These lease payments are made by the lessee. Now, what are included in lease payment? Fixed payment, payment based in substance fixed payment, payment based on index or rate, correct? All of that, lease payments are included, whatever is paid by the lessee, including the guaranteed residual value, the bargain purchase option, and all of that. To this, you will add any unguaranteed residual value. That is the gross investment in lease. So, gross investment in lease is the lease payments plus unguaranteed residual value. Now, what is this unguaranteed residual value? In the lessee's discussion, we understood that the residual value can be guaranteed, it may not be guaranteed. If it is guaranteed by the lessee, then that is a part of the lease payment. If it is guaranteed by the lessee, it is a part of the lease payment. Then, even if there is a residual value guaranteed by a third party, that also will consider it to be a part of lease payment from the standpoint of view of the lessor. So, lease payments by the lessee plus guaranteed residual value by any other third party plus unguaranteed residual value, all of these put together becomes your gross investment in lease, right? So, that is what is the gross investment in lease. So, and what is net investment in lease? Net investment in lease is the gross investment in the lease discounted at the interest rate implicit in the lease. Discounted at the interest rate implicit in the lease. So, you will calculate the IRR, and using that IRR, whenever you discount the gross investment in lease, that will result in net investment in lease. So here, for example, if I run you through this example, no need to calculate. Commencement in year 1, lease term is 5 years, lease payment fixed. So 2 lakhs will be paid at the end of each year, out of which residual value is 2,50,000, which is out of which guarantee given by lessee, is 2 lakhs, which means 50,000 is unguaranteed, and fair value of asset is 10 lakhs. And there is an initial direct cost to the lessor of 10,000. Now please remember, whenever there is an initial direct cost, when we calculate the IRR, we will compare the lease payments and unguaranteed residual value with fair value plus initial direct cost. So what we do is, fair value plus initial direct cost, it is like an outflow. I gave a fair value of car, or I gave a car having fair value of 10 lakhs, plus I incurred 10,000 on my, let us say, registration charges or lease registration charges. So think of it that, what is lessor giving? Lessor is giving 10,10,000. And in return, lessor is getting 2 lakhs of lease payment every year. Guaranteed residual value of another 2 lakhs, and 50,000 of unguaranteed residual value. So all of these cash flow, for this, if you calculate the IRR, for all of these cash flows, if you calculate the IRR, means fixed lease payments plus the guaranteed residual value and unguaranteed residual value, all of these put together, if you compare with the initial outflow asset that I have given and the registration charges that I have incurred, if you calculate the IRR, I have used a formula, this will be given to in the examination, that is called interest rate implicit in the lease. So when we do the calculation, please remember, you have to compare the fair value. With what? Fair value plus IDC with present value of lease payment, that is the IRR. Now, all these lease payments discounted at this IRR, including this GRV and IRV, whatever is the value you get today, that will be the net investment in lease. So investment means how much am I incurring in the lease? 10 lakh of car, 10,000 of registration charges. So my net investment in lease in this case will be 10 lakh 10,000. Sir, how is it 10 lakh 10,000? Because that is what I am investing. And if you discount all of these using this rate, you will still get 10 lakh 10,000. Then out of the 10 lakh 10,000, I have given a car. Now it could be my inventory. In that case, I may be a dealer lessor. I'll come to it separately. Here I am talking about, it is my fixed asset. So 10,000 or 10 lakh 10,000 is the net investment in lease that I have to receive from the lessee. I call it net investment in lease, or I will account for it as a lease receivable, because 10 lakh 10,000 is the present value of what I will get from the lessee. Then what am I giving? I am giving property, plant and equipment, my car, 10 lakhs, which is the fair value. Then to bank, whatever I have incurred as IDC. That is how I will be calculating the net investment in the lease. So first accounting treatment is that you will account for lease receivable at net investment in lease. Net investment in lease is present value of what? Lease payments plus unguaranteed residual value. So present lease payments plus residual value plus guaranteed and unguaranteed, that if you discount at interest rate implicit in the lease, that will be called as your net investment in lease. And net investment in lease will be accounted for as lease receivable initially. Then how do I subsequently account for it? When you subsequently account for it, like we prepare a lease liability schedule for lessee, we will prepare a lease asset or lease receivable schedule for lessor. So using the IRR or interest rate implicit in the lease, we will take the opening balance, that is in this case is 10 lakh 10,000. Interest, this is charged at 10 lakh 10,000 into 6.61672%. Then payment received 2 lakhs. Like this you continue to calculate, and at the end of the 5th year you will get a closing balance of 2,50,000. So what is this closing balance of 2,50,000? The residual value. Now from that residual value, if I get a party who will get, who will buy this asset from me at 2,50,000, it gets knocked off. If I get more than 2,50,000, I'll make a profit. If I get less than 2,50,000, at least I'll get 2 lakhs. So that 2 lakhs I'll account for it and balance will be written off. Okay. That subsequent selling and all of that, that is not tested at your level. These are slightly more practical concepts than your theoretical aspects or exam testing purpose. Okay. So to quickly revise, gross investment in lease is lease payments plus UGRV. UGRV is the RV which is not guaranteed either by the lessee or any other third party. Net investment in lease is the present value of gross investment in lease. You will account for lease receivable at net investment in lease. So at the lease commencement, a lessor accounts for a finance lease as a lease receivable, which is net investment. You will credit the asset. So what is this crediting that asset? You will de-recognize the carrying amount of underlying asset, and you will recognize any profit or loss in the P&L. Sir, can there be a profit or loss? Yes, there can be a profit or loss, because I may have an asset of 9 lakh. I may have an asset of 9 lakh, but the fair value of the asset may be 10 lakh. So in that case, I will have a gain. So how do we calculate interest rate implicit in the lease? The rate of interest which makes present value of lease payments plus UGRV equal to the sum of fair value of asset and initial direct cost of the lessor. Please remember, we'll discuss this subsequently. If there is a manufacturer or dealer lessor, IDC is excluded from calculation of IRR. Okay, so that is one thing you have to keep in mind. You can make a separate note of it. Now, when it comes to subsequent recognition, this interest income is recognized and payment will reduce the lease receivable. If there are impairment requirements, derecognition requirements and all of that, because it is an asset, we will refer to Ind AS 109, one of the another standard where students are really scared. How many of you are actually afraid of financial instruments as a chapter? If you can just put a comment. How many find that financial instrument as a chapter should not exist in CA final, or it would have been better if it is not there as a part of our syllabus? Anyone who feels that financial instruments as such, they have made it unnecessarily complicated? No one? Good. One. Okay, so now I think the stream has reached now. Okay, so I got 1, 2, okay, 3, tough to understand. Okay, I know. So we just going back when I was a student, we used to have this ACE 29, 30, 30, 31, 32, which was not notified. Okay, then there was guidance note. So we still had a chapter called financial instrument chapter, and that financial instrument was really scary for us. Okay, so now how do we handle that? That is okay, so Ranjit has a next level of scarcity, but your classes made easy to me. Okay, thank you. If that made easy to you, that is nice. So what we'll do is, when we do financial instruments, or why I'm discussing now, is so that you understand how we will approach it. Financial instrument, 80% of it, I'm giving you with 100% confidence. Okay, 80% of it is about understanding the concept and solving the problems. There are difficult aspects, like when it comes to financial guarantees, that concept may be difficult. Okay, and then when it comes to embedded derivatives, then it becomes difficult. 20% is difficult, I'm not saying no, but 80% is straightforward. You can understand, if you can understand it logically, nothing like that. And then out of that 80%, whenever a question comes in the examination, I'll tell you, compound financial instruments, or there is case around recognition of lease liability, amortized cost method. Most of these you can solve it easily and you cannot make a mistake. Okay, so 10 to 15 marks from that chapter will be in your pocket whenever we do financial instruments. That is when you will be able to understand, because there is a unnecessary fear created around that chapter which should not be there. It is more logical. I know it's a lengthy chapter, I am not saying no, but still we will be able to handle it pretty well. Okay, so that is my promise from my side. uh, Provided you do what is expected to do from you, and then we will be able to do that. Chalo. So coming back to our discussion. So finance lease subsequent measurement, you will recognize finance income using the constant rate. Then you will reduce the lease receivable. If there is any derecognition to be done, you will apply Ind AS 109. And if there is an impairment done, you will apply again Ind AS 109. If there is a reduction in estimated unguaranteed residual value, you will revise the income allocation over the lease term. What basically it means is, think of it. Today I thought it will be 50,000 unguaranteed residual value. Considering that, I have calculated IRR. Now I believe that it will not be 50,000, it will be 20,000. So accordingly, I will reduce the interest rate and reallocate the income. Variable lease payments that are not included in net investment in lease are recognized in P&L. So other than in substance variable lease payment, any other variable lease payment will be recognized in the income statement. Okay. Now the next part is operating lease. Now operating lease, one concept which a lot of students may have missed to understand, especially the conceptual part. So when it comes to operating lease, this is not a finance lease. Now if it is not a finance lease, you will have to account for lease income. Now I have a question for all of you. Let us say it is a 3-year lease. Year 1 lease payment is 1 lakh. Year 2 lease payment is 1,50,000. Year 3 lease payment is 2 lakh. Meaning to say, every year you have to pay 1 lakh. So 1 lakh will be paid by the lessee to the lessor as rent in year 1, year 2, year 3. Now in year 1, what should be the lease income? How much should be the lease income to be recognized in year 1? Why we should subsequently remeasure using Ind AS 109? Because Ind AS 109 tells us how to subsequently recognize, impair, measure financial asset. So here subsequent measurement is as per Ind AS 116, but if there is an impairment thing, we will have to apply the concepts of Ind AS 109. Okay, so all your account receivables, loan receivables, all of that are financial assets which are covered by Ind AS 109. Now, what is the lease income to be recognized in year 1? $1.5 lakhs. 1 lakh. Okay. Anybody else? $1 lakh. 1,50,000. Size on balance sheet. Okay. Right. Now this concept you would have learned in AS 19 also. Accounting standard 19 also has the same concept, but most of the students skip or they don't learn it the right way. That is where the conceptual understanding becomes very, very important. Okay, this is a conceptual question. Whenever there is an operating lease, lease income is recognized on a straight line method. Lease income is recognized on a straight line method. Now what is the meaning of straight line method? Straight line method means total up 1 lakh, 150, 2 lakhs. So this becomes 4,50,000. This becomes 4,50,000. This 4,50,000, when you divide it by 3, you get 1,50,000. So whatever is the payment, irrespective of that, you will account for the lease receivable or lease income at 1,50,000 each year. So year 1 1,50,000, year 2 1,50,000, year 3 also 1,50,000. So in all 3 years you will account for it using 1,50,000. Okay, that is one thing you have to keep in mind. Sir, but we are receiving only 100, balance 50 receivable. 150 you have received, 150 is the income, 100 is the received, 50 is receivable. Second year 150 income, 150 received, no problem. Third year 150 income, 200 received. So the first year gets accounted for. No discounting required, and straight away on a straight line basis or any other systematic basis if it is available. Okay, that is credited to income statement. Then one important thing what we need to understand or distinguish when it comes to finance leases. In case of finance lease, because the risk and rewards of ownership are being transferred, we will de-recognize the asset. When we de-recognize the asset, we do not charge any further depreciation. Whereas, if it is an operating lease, in case of an operating lease, we do not de-recognize the asset. We do not de-recognize the asset. So, we will continue to charge depreciation in case of an operating lease. Then, if there is an initial direct cost, you will add it to the cost of the asset. Okay. So, initial direct cost in case of finance lease will be used to calculate implicit rate of return. In case of manufacturer, dealer, lessor, you will expense it. You will not include in the carrying amount of the lessor, carrying amount of the lease receivable. Then, when it comes to operating lease, initial direct cost is added to the cost of the asset and expense over the lease term. Any questions so far? See, if operating lease payment is based on variable pattern, then it becomes variable payment. Variable lease payment, whenever you get the variable lease payment, you will account in the income statement. Okay, yes. So that covers our discussion so far on operating leases. Now, just give me a moment. Yeah. Now, the next discussion is manufacturer, dealer, lessor. See, so far what we discussed for finance lease, it is more from a financing point of view. That is, even if I am not manufacturing the asset, I'll purchase the asset and I'll give it to somebody as a financer. Okay, so I'm financing the asset. But sometimes there may be manufacturer or dealer lessor. Now, what is this manufacturer, dealer, lessor? Or just to give you a perspective, there are some NBFCs which are lease financing company. Now, what do these NBFC do? They buy, let us say, car, and then they give it on finance lease. Okay, this is one category. Now, when we say manufacturer, dealer, lessor, they are the dealers. So they don't buy asset for financing purpose. They are the dealers. And the same dealers, what do they do? The same dealers give it out on leases. The same dealers give it out on leases. Think of it, car dealer. Car dealer, the business is not to enter into finance. Car dealer is to buy and sell cars. Now, sale will increase when you give it on rental basis or EMI basis. So what did they do? Apart from selling the car, they will also enter into a lease transaction. So there is a manufacturer dealer case where you can have a manufacturer who is leasing the asset or a dealer who is leasing a asset. Okay. Now, how do we account for it? How do we account for it? And for this, we will take one question as well, so that the concept is absolutely clear for us. Right? Manufacturer dealer lessor. How do we account for it? Now, for manufacturer dealer lessor, let us take case of a dealer. Dealer sells car. Normally, when a dealer sells car, what does he get? Revenue. He gets revenue. Now here, what the dealer is saying is, he's not selling the car. He is giving this car on a 5-year lease to a lessee. Now when it's giving it on a 5-year lease to the lessee, he sells the car normally, but he's giving a 5-year lease. And this is a finance lease. This is a finance lease. Now if it is a finance lease and the dealer has given the asset on a finance lease, what it means? It means that the risk and rewards incidental to ownership is being transferred. The asset is being transferred. When the asset is being transferred, we have to recognize revenue. So even though it is a lease transaction, whenever there is a finance lease, we'll have to recognize revenue. Now, how do we account for revenue and all of that? Let us get into that discussion. So, if it is a finance lease, you will recognize, number one, revenue. What is the revenue? Revenue will be lower of fair value of the asset and present value of lease payment. Whichever is lower, that part will be recognized as revenue. Because normally, if you see, whenever there is a buy or sell transaction, the buy or sell transaction will happen at fair value of the asset. Normally, if you go to the market also, at what rate will you buy? You will buy at the fair value of the asset. But sometimes the dealer may give a discount by saying, okay, because I know you, or because I want to give you a discount, I want to increase my sale, I'll give 20% discount. And because of the discount, the lease payments are lower. The present value of lease payments are lower. So in that case, we will account for revenue at present value of lease payments. And sometimes what also happens is a very interesting case which can happen, that is no cost EMI. No cost EMI. Now tell me one thing, in no cost EMI, in case of no cost EMI, what happens? The original amount, let us say 1 lakh, over a period of 5 years, 20,000, 20,000, 20,000, 20,000, that is how it is split. Now, interest is not being earned. The seller doesn't earn interest, but the seller is effectively giving a discount. And if I discount this 20,000 over a period of 5 years, it will be less than 1 lakh if I use the market rate of interest. So, present value of lease payments in that case also will be lower. So, to handle these scenarios where companies may enter into saying that, okay, we will not have, or we will not charge interest, but indirectly you are giving a discount. Indirectly you are giving a discount. Then in that case, what you will do is you will use the market rate of interest and you will account for the transaction. So if you look at this example, just a moment. Now, Just have a look at this example. This is an improvisation of what we have done earlier. 5-year lease term. Lease payment is 2 lakh fixed for 5 years. Fair value of the car is 10 lakhs. Now tell me, is the lessor, is the seller making any interest income here? If you just look at the transaction, 10 lakhs is the fair value, and I tell you that you pay me 2 lakhs each year for 5 years. Now if that is the case, what happens? If that is the case, it appears that as if there is no interest. But what the standard says is, open the transaction and see. I know there is no interest. Maybe there is a discount which is being given to the lessee. So in that case, what you do is you calculate the two aspects: fair value of the asset 10 lakhs and present value of lease payment at market rate. So say for example, 6% is the market rate. If you go out in the market, you will get, I'll use a highlighter so that it is easier. You go out in the market, you will get 6% rate of interest. So if I have to pay 2 lakhs each year for 5 years at 6% rate of interest, what is the present value? 842,460. So fair value of asset is 1 lakh, but 842,460 is present value what I am earning. So revenue should be recognized at the lower of these two, which is 8,42,460. Sir, what if the present value of lease payment is higher? See, generally present value of lease payment will not be higher than the fair value of the asset, because nobody would want to buy an asset at a higher than fair value price, right? So in most of the cases you will see that it is fair value of asset or present value of lease payment, whichever is lower. Sir, but still we got a scenario where fair value of asset is lower. If fair value of asset is lower, you will recognize revenue at fair value of asset only, and accordingly the discount rate also will be changed. Okay, so you will recognize at lower of these two. This happens in case of low rate transaction like no cost EMI, or the manufacturer giving or dealer just to sell the inventory giving lesser than discount rate, like lesser than the market rate. We also give, right, no cost EMI whenever you purchase a course. Now when we purchase the course, we give you no cost EMI, but we are bearing the interest. So here also, when they say they are giving you without any interest, the interest cost is indirectly borne by the manufacturer lessor. So you will calculate both of these, and lower of these two you will account for it. Then here we have assumed that the cost of the car is 9 lakhs. If the cost of the car is 9 lakhs, revenue is 8,42,000. The difference 57,540 is the loss which will be recognized. Okay. Now how do we account for this? In case of manufacturer, dealer, lessor, how the transaction is accounted for? First, the lease receivable and revenue. Revenue, again I am repeating, lower of fair value of the asset and present value of lease payments at market rate. So lower of the two will be revenue, that amount will be lease receivable. Okay. So then what about the asset being transferred? The inventory will be transferred to cost of goods sold, because that is now an expenditure. Okay. So that is how you will account for a transaction which involves manufacturer, dealer, lessor. Another case example, if we take here, revenue, fair value of asset is 10 lakhs. In this case, present value of lease payment is also 10 lakh. So you will recognize revenue at 10 lakh. So the entry will be lease receivable to revenue, accounting for revenue, and COGS to inventory 9 lakhs, 9 lakhs. Now, one challenge what students find here is, institute gives a combined entry and you do not know which entry to take where. So the logic that you have to understand here is, the revenue will be recognized at lower of fair value of asset and present value of lease payment. So that amount will be the revenue. So that will be lease receivable debit to revenue, and the inventory carrying amount will be transferred to cost of goods sold. So that becomes your expense item. Okay. Then subsequently what you will do, you will account for interest income and all of that, as we understand in other cases as well. Now let's have a look at this question. A dealer lessor enters into a 10-year lease of equipment with lessee. So it's a dealer lessor given in the question. The equipment is not specialized in nature and is expected to have an alternative use to the lessor at the end of 10 years. Okay, so it's not a specialized asset. Fine. So it is not a specialized asset means the asset will come back to the lessor. Lessor receives annual payments of 15,000 payable at the end of the year. Lessor expects that the residual value of the equipment will be 50,000 at the end of the 10-year term. Lessee provides a residual value guarantee that protects the lessor from the first 30,000 of loss for a sale price below the estimated residual value at the end of the lease term. So, guarantee that is given is 30,000. Equipment has an estimated economic life of 15 years. Lease period is 10 years. Carrying amount of 1 lakh and fair value of 1,11,000. The lease does not transfer ownership of the underlying asset to the lessee. So, ownership transfer is also not there. Lease term does not have option to purchase. That is also not there. The interest rate implicit in the lease is 10.078%. So, now why have they given this multiple times that they will not transfer, there is no option to purchase and all of that? The reason being that the asset will come back to the lessor at the end of the finance lease. But sir, in finance lease, the ownership is transferred. No, ownership is not transferred. Substantially, all the risk and rewards are transferred. So, for a 10-year period, substantial part of the asset is used, but the legal title is still with the lessor. Okay, so that is one thing what we need to understand in this type of question, whether the ownership is actually getting transferred or not. Okay, now just a second. Now here, so normally I would not in the examination, but initially when you practice, if you make a format like this to note down all the important points given in the question, you will not be forgetting. And here we will understand, sorry I didn't say this. Here we will understand all the aspects of finance lease once again. Okay. So now here, the lease term is 10 years. The lease payment is 15,000. Guaranteed residual value is 30,000. Unguaranteed is 20,000. Fair value is 1,10,000. Carrying amount is 1 lakh. Useful life is 15 years. IRR is 10.078%. Okay. Now, if you look at the lease term is 67%. Under this condition also, it is not a finance lease. There is no option to purchase. There is no transfer of asset. There is not a specialized asset. In all of these cases, it is not a finance lease. But if you see the present value of lease payment, and if you compare that with the fair value of the asset, then in that case it meets the criteria and hence it is classified as a finance lease. Okay. So, interest rate I have just calculated it here again, not needed once again. Okay. Now, gross investment in lease is 2 lakhs. How did we get this 2 lakhs? Total of all these payments, lease payments plus guaranteed residual value plus unguaranteed residual value, that gives me 2 lakhs of lease payment. Net investment is 1,10,000, present value or the fair value of the net investment in lease. Then unearned finance income 89,000. Now, present value of lease payment. Please remember, when we say present value of lease payment, that does not include the unguaranteed residual value. Present value of lease payment does not include the unguaranteed residual value. So, present value of 15,000 for 10 years is 91,000. You can calculate it, or I'll share with you the Excel. Present value of guaranteed residual value is 11,484. Both of these put together is 1,03,344. Fair value is 1,11,000. So, it covers more than 90%. Hence, it is a lease. It is a finance lease. Okay. Please remember, lease payment does not include unguaranteed residual value. Whenever you do these calculations. Now, how do we recognize revenue? Revenue will be recognized at lower of fair value of asset and present value of lease payable. So, fair value of asset is 1,10,000. Present value of lease payable lease payment is 1,03,344. So 1,03,344 is the revenue. Okay, now 1,03,344 is the revenue. How much is the cost of goods sold? If you come back to the question, it says carrying amount is 1 lakh. Carrying amount is 1 lakh. Normally, the carrying amount will be your cost of goods sold. But here, the asset is coming back to us after 10 years. Means entire 1 lakh is not my cost of goods sold. Today, I am giving 1 lakh to another party, cost of goods or asset. After 10 years, I will get back. How much will I get back after 10 years? After 10 years, I will get back the 20,000 from a third party. Okay. This first party, whatever is the lessee will pay me at least 30,000. So that 30,000 I have already considered that I will receive. Whatever I will not receive from the lessee, I will receive from the third party. So that is something a separate asset. So the way you have to understand this is, when I calculated the lease receivable, here I have already included 30,000. So I will get 15,000 per year and 30,000 of the guaranteed residual value from the lessee. Okay. Apart from that, I will get 20,000 worth from a third party. So while calculating my cost of goods sold, this present value of unguaranteed residual value should be considered as a reduction from my carrying amount. The reason is, out of this 1 lakh of asset that I have transferred, I have some lease receivable which I already received from the lessee. Apart from that, there is a third party which is giving me a guarantee, there is a third party which has not given me a guarantee of 20,000. That 20,000 is a benefit to me, which I believe is what I will receive. Something like residual value. Something like residual value. Sir, why did we not consider the other residual value? That I will anyways receive. That is already included in my lease receivable calculation. Here, if I have to recognize one more asset, if I include, so I'll just give another perspective. If I include both 20 plus 30 here, I am double counting, because here I have already included it in the asset. So here I should not include it in the asset in the residual value once again. So carrying amount minus present value of unguaranteed lease receivable residual value will give me the cost of goods sold. So my revenue is how much? 103,344. That is my revenue. Okay. Then cost of goods sold is 92,344. Profit is the difference between revenue and cost of goods sold. If you have to split it, I'll just show the entry. Lease receivable from lessee. It is how much? Lease receivable from the lessee is 1,03,344. To revenue 1,03,344. This is an area where again there is, sometimes students get confused. So that is the first part. Second, cost of goods sold. How much? Cost of goods sold we have calculated to be 92,344. Okay. Cost of goods sold, debit lease receivable UGRV, the residual value that I will not receive. How much is that? That is 7656. Credit asset that I have 1 lakh. Okay. So and my profit will be revenue 103,344 minus 92,344. 11,000 is my profit. Okay. So here when we pass the entry, you can do a combined entry. Lease receivable, this is lessee plus UGRV. Okay, the residual value. So today we are giving asset worth 1 lakh. Out of that 7656, I will receive as an unguaranteed residual value. Balance is my cost of goods sold. And when you have to recognize the interest, you will take the total lease receivable, that is 1,11,000 and recognize 10.0783. Sir, why are we including unguaranteed residual value? The simple reason is when we calculated this, here also we have included the unguaranteed residual value. So that value will also increase. So when that value will increase, the interest income is also recognized on the combined amount. And at the end of the 10th year, the residual asset becomes 20,000. Any question on this? Sir, the material you provided at the starting is having only questions. See, answers are not compiled in a way where you will be able to understand. Okay, it will be able to it will be very difficult for you to search the answer. It will take you more time. Most of these questions are arranged in the order of the study material only, right? So what you can do is, uh, for your practice purpose, for you to handle the material, I'm compiling it separately. The work is going on. Once it is available, I can give it off to you. But what you can do is, these questions, that is the questions that are given in notes, right? So the ones which involve calculations, you can pick it up from the study material and refer back to the answers. I know it is slightly complicated, but easier way to do that is you can use control F. For example, I'll just tell you how you can do it. So the questions which are given have the same thing. Mostly they are in the same order unless the institute has not followed an appropriate order. So here, for example, it is 10-year lease of equipment with the lessee, okay, or a dealer lessor. You can just search dealer lessor in the study material. You will get to the solution. And one reason why initially we don't give solution with the question is otherwise student will read the solution rather than practicing the solution. So that is one more reason why we don't give solutions. Okay, otherwise if I've seen students, sir, can we get question bank with solution, can we get chapter wise all questions with solution, then what you will do, you will just read the question, you will read the answer, and you will not practice. But I know students have that requirement, and we're thinking of compiling, and we will be, I don't think I can commit for the November attempt, but you can still practice them and cross check the solution. That will help you in practice also. Okay, right. So that brings us to this discussion about manufacturer dealer lessor. Just two quick discussions here left. Profit or loss should represent profit or loss from an outright sale. So whatever is the profit or loss, that should represent normally how much would be the sale. If artificially low interest rates are quoted like zero cost EMI or no cost EMI, lessor recognizes profit considering market rate of interest. So you'll calculate using the market rate of interest. Then cost incurred by lessor are expensed. So you do not include them as a part of calculation of IRR. If it is an operating lease, then you only account for it as an operating lease because asset is not being transferred. So that brings us to the end of the discussion around manufacturer dealer lessor. Now we are left with two important topics. One is lease modification. So we have already done, that is modification of contract. Lease modification like finance becoming operating, operating becoming finance lease, and sale and lease back transaction, which we will continue tomorrow. I am available for another 2-3 minutes if you have any questions, or if you want to personally ask something. This time you can utilize this time to ask. I hope the sessions are useful to you. You are able to achieve some amount of conceptual clarity from whatever we are discussing in the class. No questions? So it means two things: either you have understood everything well, or a lot of you are actually sleeping, and we'll see recorded one. After this 115. See, disclosure and presentation very very less, and as far as if you ask my strategy, I am not saying you should follow that. Read the disclosure and presentation, what is given in the notes, that is summarized manner. I used to read it only once or twice, okay, because it's too much of too many things to remember. One way to understand presentations better is what I am actually what I actually do in the class, in my uh, recorded classes, animated classes. What you get, what I actually do is I'll just show that to you. Couple of minutes, just be here. Just share what I do in the class, and Institute has done that in the new study material. We've been doing this for the last 3 years, because that is how you will learn. See, objective should be not only passing the exam. After you pass the exam, after we pass the exam, we should be able to apply it better also, right? So I'll just share something with you. So this is what I keep on telling in every standard, and I want all of you also to now, if you just read this annual report, I know it is slightly smaller in size, I'll just increase the size further. If you can just read this annual report, what does it say? At the inception of the contract, the company assesses whether a contract is or contains a lease. Contract involves the use of an identified asset. Then, what are the practical expedient use? The company recognizes a right of use asset and a lease liability at the lease commencement date. Right of use asset is initially measured at cost. Okay, so all of these things, that is covered in the disclosures which are given by all of these, companies, listed companies. If you look at that, the kind of clarity you will get will be amazing. Like, see, property, plant and equipment, what is the estimated useful life? So disclosure part, even if you are able to read this once, it will actually help you. So see the breakup: owned asset, given on lease. Okay, so what is the disclosure, or what is the breakup of that? Then I'll just show you few more. See, classification: current lease liability, non-current lease liability. What is the interest expense on lease liability? What is the variable lease payment not included in the measurement of the lease liability? So all of that they disclose it. And then the right of use asset: land, building, plant, machinery, whatever is there, so that is also disclosed. So this tells us what all things to be disclosed in the financial statement. And any standard you take, intangible assets are measured at cost or fair value. They have taken two things: internally generated intangible asset, research costs are charged to the statement of P&L. So many times we get question based on this. Research cost is so much, development cost is so much, right? So once you learn this, once you read this once, cost of internally generated intangible asset is sum of directly attributable expenditure incurred from the date when the intangible asset first meets the recognition criteria. So this becomes your summary. This becomes your summary for all the standard. Sir, we don't have sufficient time. Just spend 10 to 15 minutes every day. Just read the accounting policy and financial statement. Your understanding of the standards will be next level. Okay, I cannot emphasize more on this, but it will be most useful to you to understand how things happen. What happens, investment, what all things to be disclosed here, subsidiaries, everything. And these kind of financial statements, especially of your what do you call, the aspects related to listed companies, that helps a lot. Okay, so that is what I would suggest all of you to go through. Even if you have limited time, 10 to 15 minutes per day, read 2 3 accounting policies. It will be a really good revision technique for you. And when you start working at that point of time, or when you are practicing also, you will be able to give amazing value to all your clients. Okay, so thanks a lot again. And can we complete all of the chapters? Yes, my target is to complete all of the chapters, to be frank. So just to give you a perspective, leases in a normal class is 16 hours. We have almost covered 80% of leases in about 6 hours. Okay, so that's why it is not a full-fledged class. So those of you wanting in-depth conceptual clarity, you should supplement this with either further classes or further self-study, whatever way you find it. Please don't take this as a replacement of a full-fledged learning. That is my humble request to each one of you. Okay, chalo, thanks a lot, and we'll see you tomorrow once again. Bye.